Australia's debt-fueled property boom. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee, let's look at this article from The Guardian because it's discussing our housing property boom. But it's all based on massive debt. You know, I think we're number 2 in the world last time I checked. Come on Aussies, you can do it better, take on that debt. Take that second, third, fourth, fifth mortgage. Remember, interest only. Don't, paying capital or paying the principal. That's dead money, guys. It's just interest only. And then what you want capital growth. And if you're working in the university or education sector, make sure you buy all of your investment properties directly tied to that one sector. Because don't worry, nothing ever goes wrong, mate. She'll be right. Did I get it right, guys? Can I be a property spooker now? Spooker now. Oh, it feels like it, doesn't it? I mean, there you go. It's scary hearing the stories of how much debt some people are taking on. It is just scary. Some people are letting us know in the comments of how much, people with 100 grand a year income are borrowing, and it's nuts. Now, one thing that's interesting, we've looked at a few articles, is the discussions around mortgage stress and how much of your money, your income coming in, needs to be put aside to pay for your mortgage. If it's over 25%, the argument is that you're in mortgage stress. Now, I'd like to challenge that. I'd just like to put a question to you all. Now, maybe that's based on the past when previous generations didn't have to, kind of save a deposit as big as the moon to get into a house, where deposits now are, nearly half of what people would pay for a house back in the day in some circumstances. So do you think perhaps this generation is used to saving insane amounts of money to borrow? So maybe the 25% isn't such a bad thing. Maybe it needs to be higher. Or am I just being naively optimistic? What do you reckon? Do you think there could be some basis to that we're seeing all these calls for mortgage stress, but it doesn't really seem to be affecting that many people? Or, and I think this is even more likely, could it be because money is being flooded into the economy through JobKeeper, mortgage holidays? You can't be in mortgage stress if you don't have to pay that mortgage. You've got the doll bonus, which now they're calls to put that even higher. Now, I understand it's bloody low, but it's meant to be an emergency payment for a temporary, at least that's how I see it, an emergency payment for a temporary period of time for someone who does not have enough resources to take care of themselves. It's not UBI. It's not meant to be a lifestyle. You shouldn't expect them to take care of you, guys. Because if you've been smart and saved money, you need to burn through all that before you even get a look in. And honestly, if you got 20 grand in an emergency fund, you'll probably find a job before you even burn through it. If you don't adjust your lifestyle, if you're still living like a king and you burn through it, well, then you've got other problems. Anyway, back to this. Let's have a look at this. Because we've got a debt-fueled housing boom where the government is you've got home builder inflating the prices, you've got incentives in every state inflating the prices, you've got banks not repossessing properties until September, you've got banks giving holidays on mortgages. So yeah, it's a completely normal market, guys. Nothing to see here. Nothing to worry about. Oh yeah, and I forgot the record low interest rates. A cash rate, 0.1%. We've fixed our mortgage at 1.99. We just locked it in for 4 years because we are doing a big renovation on this house. I've been chopping down trees, doing my videos in the morning, working on architecture, or cutting down trees and starting to clear. I tell you, up in a big tree, it doesn't look that much until it's on the ground when you're cutting it off. And I had a bloke rock up to offer to cut down the trees, walking around. I go, he's going, oh, how much you want that? You want to cut that down? I'm thinking $50. And then I thought about it. I'll just keep the $50. And I'm too lazy to use the chainsaw too, because I got to oil it and adjust the chain and everything. And I'll just use the branch saw and just, go at it by hand. There we go. Anyway, enough of my story time. Let's have a look at this, because the point of saying that, the reason why we fixed was because we're going to be doing a big renovation here on our house. And even though we're fixed at 1.99, Rachel's going, wow, because we're only paying the minimum on it, because you can't you know, you can only put 10 grand extra a year, so it's not worth it. She's going, wow, is it still making a dent in it? And this is just the minimum repayments. It's so low, guys. And there's talk of it even going lower. There's some banks now at 1.6. It's crazy. And there's some people are concerned, oh, what if it goes up? What if it skyrockets again? Then everyone will fall over. Will it even be possible, guys? Look at what they've done to prop up the market now with a recession. Look at how much burden they've put on future generations. They don't care. Can you imagine the outcry? The Australian housing market is going gangbusters, and all signs are that the boom is here to stay. When property data from CoreLogic tracked 1,119 auctions last weekend, it found 86.1% of the properties that went under the hammer sold, a 2.3% increase on the week before. Okay, now, here's the thing, guys, with the auction clearance rates, you've got to understand, and I'll bring this up, it's a trend. It's a trend, everyone. If you go here on my website, you can see here where we looked at just, there's a range in the way they calculate the data. So here's one, an advertised rate was 74% sold. Now the range of that data was from actually 60% only sold to 79% only sold. So it's a bit of a spread. You've got to realize real estate agents, they're gregarious or these the good ones, are gregarious outgoing people. They're not always going to want to report their failures back to the you know, CoreLogic. Place across the road sold. They had an auction. Auction didn't go ahead, but it sold in private sale. Wonder if that was recorded. So, the company's head of research, Tim Lawless, says it is a result not seen since 2015. When auction clearance rates are high, you expect house prices to be rising and vice versa, Lawless said. At the moment, we're seeing clearance rates well above 80%. The last time we saw the same was in 2015, but you have to go back a decade to see auction markets as strong as this. House prices continue to grow strongly through January, with CoreLogic Home Value Index recording a price growth of up to 0.9% nationally, and regional areas growing at rates double that recorded in the cities. Nerida Kniesby, chief economist at global real estate company REA Group, said the situation was driven by a combination of cheap money, a high savings rate among those who held onto their jobs throughout 2020, a receding pandemic, and an exodus from the densely populated Sydneys into regional areas. Now, one thing she's highlighted there is the big difference, guys. You've got some people who have not been affected at all by this economic restrictions. This is the class divide here. Everyone, Australia, this is the class divide, and it's just going to be exacerbated by this moving forward. You're going to have some people who saved more money because they couldn't eat out, they couldn't go overseas, they couldn't piss it away. So, and then you've got all these artificial low cash rates, and they're thinking, oh, well, let's get a house. You know what? I can work remotely now. Let's go out of the country. Or I want to get out of Afghanistan, so I'll go interstate. Or I'll go regional. At least if I'm locked in my house, I've got some land. Or trees to chop down. So, that's going to be interesting, you know, moving forward. One group going that way, the other group going that way, guys. You're watching a realignment as people work out where they want to live and where they want to be employed, Kniesby said. The recession we saw with the pandemic is not quite like what we've seen elsewhere in the GFC, where it was finance-led. What that's meant for property is there's no shortage of money. Interest rates are at incredible lows, and those who had jobs were forced to save during rounds of lockdowns. However, while property values in regional areas like South Queensland and northern New South Wales have been growing, Kniesby said units and apartments in city areas have remained flat thanks to lower migration and international students dropping off the cliff. I mean, who would want to buy an apartment now if you're at risk of being locked in it? Guys, I remember when we were looking for a place we were moving out of the house we were in because they kept putting up the rent. And we were looking at cheaper places, and we went through a unit, and I'm going, no, we can't raise a kid in this. We need to find a house somewhere. We need to buy one. We need to do something. So, when you have a look across Australia, you're seeing price growth everywhere, but at a suburban level. Particularly those closer to universities, rents have dropped and values have dropped, she said. The activity comes off record low interest rates of 0.1%, a situation the Reserve Bank of Australia expects to hold until 2024. RBA Governor Philip Lowe shrugged off any concerns that the country may be facing the start of a new housing bubble earlier this month, saying the growth was good news for an economy recovering in the wake of the pandemic. There's a lot of focus at the moment on the fact that housing prices are rising again and the stock market has been strong, Lowe said. Well, the National House Price Index today is where it was 4 years ago, and the equity market, we're back to where we were at the beginning of last year. See, this is the thing. The RBA isn't worried. They're not worried about house prices booming, guys. That's the unintended consequence of, well, the candle-on effect. They're flooding money into the system due to, money is going to be created by people going to the banks to borrow it to buy houses. Then you've got the candle-on effect materializing. It refers to a change in relative prices resulting from a change in money supply. This money that's created by people borrowing to buy houses is essentially the injection point of new money supply into the economy, and then we get a bubble forming in our housing sector. Then you've got no political will to allow for a correction. You've got people using it to mitigate their taxation because we're taxed to the moon here in Australia, guys. So it's a snowball effect. It's going to build one on the other. Other key factors include the government's pandemic response plan. To date, around 82,000 households have subscribed to the Home Builder Scheme at a cost of $2 billion, while other initiatives like the Cash Flow Boost program directly injected sums of up to $100,000 into small to medium businesses earning less than $50 million a year. See, I'm a sucker. I haven't got any of that stuff. We're not doing the home builder because we own a building. We want to build ourselves, just so we can save on the cost of the builder. Because the builder hires all the subbies. So we'll be doing it like that. And, like demolition and stuff like that, we can do ourselves. Pretty much. Most of it. We'll see how it goes. Professor Hall Pawson from the University of New South Wales says this cheap money has been a big driver in the recent price spikes, and that may prove disadvantageous to renters and those living in regional areas. Cheap money is the most important thing by far, he said. It is the ability to take out $150,000 more on a mortgage than you could have had a year ago on the same salary. The concern about this is that for low-income earners in regional locations, they're going to be put under pressure as a result of these changes, and it doesn't flow through to renters immediately. The federal government is looking to boost the situation further by winding back responsible lending laws, Martin North, the principal at DFA, said. The gains were not without risk, as they relied on the massive creation of new debts, he added. Scott Morrison said 3 years ago he wouldn't let prices drop, and that is proving to be true. But we're building these rises off the backs of massive debts. Problem is, people aren't going to care. People aren't going to care. If they're in a house and they're still working and they can still make money, they're saving money, they're not going to care. They're not going to care at all. People don't even care about the massive debts that our states are running up. They don't think it's their problem. But, the problem is it manifests in such a subtle way. Inflation, it's a tax that most people don't realize exists. And all of these, state costs, everything starts creeping up. I really loved it when they put up my car rego costs just after every civil servant got $1,000 for sitting on their ass in Queensland. Awesome. Awesome. They wonder why people are losing faith in our institutions, everyone. It's shocking. I don't get it. I don't get it. So, banks are lending 6 to 7 times average income. They're doing what they were doing before the Royal Commission. This is an unsustainable and a highly risky extension when we should be investing in more sustainable or long-term solutions. Dr. Cameron Murray, a postdoctoral fellow at the Henry Halloran Trust at the University of Sydney, said, "What is happening in Australia has to be seen in a global context. That's the big risk. We're still going to look, even though we're bad, we're going to look better than some of the others, so that's going to attract foreign money." Remember when we had the foreign investment boom, guys? That's their share of building approvals. Look how high that is. Look at the quality of the apartments now that you have in Sydney. I wonder if that too is manifesting in people staying away from units and apartments. The whole construction issues there. I bet it is. Even without the pandemic, he says, the world is experiencing a global housing boom. While central banks everywhere have come to view the housing market and the associated consumer spending as a key plank of their economies. Our macro stabilization policy works by juicing housing prices, Murray said. This is a policy most central banks have adopted. Secondly, we're just at that point in the cycle. The best parallel to the situation now is 2004. I think we're in a very similar phase right now. Sydney boomed early, then it tapered off. Then the rest of the country shot up for 4 years, in line with the broad global housing price cycle. The economy runs in cycles, and a lot of regional Australia hasn't been through the boom cycle. Now it's their turn. What do you think, everyone? What do you think? So, there we have it, guys. There we have it. Our housing boom based on massive debt. Now, is there any way to get off this roller coaster ride? Do they even want to get off it? Because if that's now a key policy of the central banks, our own central bank doesn't care about booming property prices. We'll see how next year goes. What do you reckon? The more and more I think back, those articles that were discussing, or even the simulations about a potential 40% fall from the RBA, 30% fall from the CBA, it feels all like it was done with intention to steer our politicians in a particular path. What do you reckon? Anyway, guys, thank you for watching. Please like, share, subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I will see you all next time. Bye for now.